Greetings, everybody. This is Jeff Scott. It is early in the morning on Monday, February 21st, 2022. I'm recording this just after I got home from a trip out to Santa Fe. My email address is hgsidoc@gmail.com. I titled today, Markets Fall from a Wall of Worry. I welcome all comments, either through email or within YouTube, and I try to answer as many as I can. As always, this is for educational purposes only. Any individual stocks I recommend is clearly in the spirit of education and not investment advice. I'm a doctor, not a broker. The tools demonstrated are those that I use in my daily trading. I have paid for all the tools that I demonstrate, and trading involves risk, and you alone are solely responsible for any investment decisions you make. I put this old slide here to remind you that stocks, indexes, sectors, everything in the market follows this pattern. And not only do they follow this pattern, it's a fractal pattern. It occurs in minutes, hours, days, weeks, and months. And you have to know where not only the market is, your industry group, your stock, where are they on this pattern? The other thing here that I think is important to know is that I talk a lot about growth stocks, and those are the stocks that I've traded predominantly over the last decade, 20 years beyond. They go up like rockets. So when they're in stage two, they're cha-cha-cha, as Ian used to say, but they fall like rocks. And right now, you know what the NASDAQ 100 has done. It has fallen like a rock. So then the question becomes, when are we done falling? And when do we stop and enter stage two again? If you think back to March 23rd-ish of 2020, it felt like it couldn't get worse. And then the market recovered. Now, it was an unusual recovery. It was a V-shaped recovery. But the whole feeling of being in the market changed within days. And we went from sell, sell, sell to buy, buy, buy. I don't think we're there yet. Let's talk about where we are. This is a chart, and all I wanted to look at were sort of the most common asset classes. And of course, I forgot to include the TLT. But since I'm an equity guy, you have stocks, you have gold and silver, you've got the VIX, and the dollar, as well as the major indexes. So what do I see? When I look at change from the beginning of the year, what's up? The VIX, oil, gold, silver, dollar. What's down? And you could see FANG since the beginning of the year is down 41%, Bitcoin 20%, the IBD 50 ETF 18.9%, and then if you look at the major markets, between 6.1 and 14.2%, but yet that's from the beginning of the year. If we look at how far things have fallen off the high, there's nothing positive. Well, there wouldn't be, because we're talking about how much off the 52-week high is, but the things that are holding up the best are gold, silver, well, actually take back silver, gold, oil, and the dollar. When you look at FANG, it's over 50% off the high, same with Bitcoin. The IBD 50 ETF is down 29.3. Now, if we consider 10% a correction, 20% a bear market, then the Qs and the Russell are deep in a correction, and the Dow and the Spiders are just in a pullback. Now, thinking of the Qs and the NASDAQ, I always like to look for Hindenburg omens, and we won't even talk about them for a while because you only see them at market tops, not at bottoms. But in the calculation, you get the percentage of new highs and new lows. And I noticed when I ran it on Friday that we had 9.56% of the stocks of the NASDAQ had hit a 52-week low. So naturally, I asked the question, what does that mean? Are we at a bottom? Does it get worse? Do we really bounce from here? So I actually looked at 20 years worth of data. And it turns out this is like day number 160 if you start with the worst day to the best day for the NASDAQ. In fact, you can look at some of these dates here: March of 2020, November 2008, December of 2018. These are some major bottoms in the market, or on their way to major bottoms. And you can look at the number of new lows as high as 53%. So yeah, 9.5 makes me stand up and pay attention, but by itself it doesn't mean we're near the end of anything. Let's look at some charts. And I'm going to be looking at this in wealth charts. And let me make this bigger. And let's take a look at what we see. So the first thing I'm always going to start with is looking at the indexes. So here we have daily charts. Let me make sure I'm on the daily of the spiders, the Qs, the diamonds, the IWM, VXX, and the dollar. So let's start here and look at the SPY because I think it tells all the stories we need to have. We had a nice run up. We know that. It's been going on for a long time. We had a pretty big pullback to the January 24th reversal lows. And then, so predictable, we ran back up, failed at the descending trend line twice, pulled back, and most recently failed at the 200. I look at this and I know nothing good ever happens below the 200-day moving average, that this is not a good-looking bullish pattern by any means, and it tells me that maybe I want to either play little, play fast, or maybe just sit on the sidelines. So I look at the spiders and I see a pretty beat up market, and you can see the trending bongo indicator, daily, weekly, and monthly, are all bearish. What about the rest? We'll go a little quicker now. Similar pattern on the Qs, failed at the 200. The diamonds failed at the 200. The IWM actually failed at the bottom of the Darvis box. If we go back, you can see that. So all of them are pretty broken, and none of them look in positions that I would expect a recovery anytime soon. The VIX, this is perhaps surprising. The VIX is up, but it's really not up that much, and it certainly has room to run. And maybe that's one thing that should temper my bearishness. And the dollar traded up at the end of the week and is sort of in the middle of its recent range. Now, I'll be the first to admit you can get ferocious bull moves even in a bear market or a correction. Some of the fastest, biggest moves occur at times like this. Think of what happens tomorrow if Biden and Putin come together and end this conflict. Well, gold falls, oil falls, markets rally. But unfortunately, they didn't fall to this level because of Biden and Putin. And I don't think that that will get us out of the mess we're in, although it could give us a multi-day rally. When I look at my guppy charts, and I'll just look at the S&P as an example, we are down at the lower range, and we're starting to see the moving averages start to flip. So we're getting into a pattern that you see with more bearish markets, and we could still bounce in a heartbeat and get out of it. But when I see this pattern where price is now trading below the 250-day moving average, which is the lowest yellow line, it's concerning for the market. And certainly for me, it's a be careful when I think about going long. If I want to look at some of the key market ratios, I'm just going to talk about two tonight. I'm going to talk about the spiders versus gold and the spiders versus bonds. These are things that you expect to roll over if the market is going into a more bearish phase. Spider versus gold has rolled over. Spider versus TLT has not yet broken down. So time will tell if we're going to reverse here and go higher. But it's concerning. When I look at the market themes, nothing has changed. Well, I should take that back. Something has changed. If I look at IWB versus IWM, and I look at what's been going on since November until very recently, big caps have led. Now, over the last couple of weeks, we've seen a reversal here and small caps started to improve. How do I say big versus small? When I go up towards the upper right, that's the IWB leading. When I head towards the lower right, that's IWM. If I look at a daily chart, you could see, on the hourly, you could see that the small stocks have really made a difference over, well, we could look at when we peaked, and we peaked here, let me get my glasses on the 28th of January. If we look over to the right and we look at growth versus value, growth pointing up, value pointing down, clearly growth remains sick as we are pointing to the lower right. And then lastly, if I want to look at the sectors that are working, I like looking at the hourly sector charts. Sorry about that, I thought I'd load it. You see how fast this loads? It's like amazing. And I'm looking to see what's pointing up to the right. So where's their strength? Well, there's strength here in materials, gold, silver, copper, ore, fertilizer. I don't know if that's a material or not. Energy, financials, and defensive staples. Other defensive plays in real estate and in utilities have not started to move. Now, I'm just going a little long already, so let's look very quickly at how I'm looking at the market. Now, I've already done my analysis and I looked at the sector scanner, and what I like to do, just to review, is I like to rank by daily algo, and from the bullish perspective, I take the top, in this case 3 sectors. I compare, I see all the different industry groups in these sectors, and I might look at the top 10 to 15. And then if I compare, I bring up the stocks there, and again I typically will go down to about 750, and you can see very quickly I got to 750. This market has clearly become much less bullish over the last couple of weeks, and I do that, and then I will take these and I'll dump them into my default watch list, which is my weekend review. Now, in the essence of time, I'm not going to do the same for the short side because I've already done it. But I create watch lists. Now, what do I do with those watch lists? I like to take them into my CAT scanner, and let's pull up the weekend review, which would be the long watch list. And let's go into my filter on the CAT scanner. And let's say I don't want to look at any stocks less than $5. I like squeezes because I find stocks that are not extended. The dots are my different momentum indicators, including big gap up, big volume, a breakout, and momentum. I want it to be on a longer term uptrend, so I'm going to go bullish bongo. And I'm going to hit apply. So I've taken a very big list and made it quite a bit smaller. And now I can handle looking at all these charts, but I can make it even better. I can rank them based upon the number of dots. And I could see if any of these stocks meet my criteria. So let's look at the first one, Allstate. And you're going to find that the more dots I have, the more excited I get. So Allstate is interesting to me. It's got volume, breakout momentum out of a squeeze, relative strength has turned up. The only thing I didn't like about Allstate, it's trading right below the 200-day moving average, and I'd like to see a break out of that or above it before I'd be interested in trading. Now, I knew this was a week that the bulls were not in good shape when Campbell Soup was one of my favorite looking charts. So Campbell Soup has been in a downtrend, ran up here, pulled back, and now it looks like it's on the verge of a breakout. 3 dots coming out of a squeeze, and in this case the EMS indicator is supportive. Exelixis is an example of a biotech stock that's starting to look interesting. Now, like Allstate, we're going to see that it too is trading below its 200-day moving average. 3 dots coming out of a squeeze. I like this one as well. And I've noticed some biotech stocks have been starting to move. One that I started playing last week was Karyopharm. Actually, I think I started maybe 2 weeks ago. Let me try that again. I'm using the wrong keyboard. KPTI. And we show you the type of pattern that I'm looking for. Now, don't look at it now, and I'm not telling you to buy it right now. But why do I like this pattern? Because as I'm breaking above the moving averages here, I started getting interested, and right in here I had an EMS indicator fire on a day that I had 2 dots. So I'm looking for stocks breaking above the moving averages with some dots, meaning volume, momentum, breakouts, and I don't like buying things that are below their 200-day. So these are some of the stocks that made it to the screen. I could also look at stocks that have new EMS signals. And one I liked also, defensive play, Flower Foods. The stock has already been in a nice uptrend, as you can see here. You can see the weekly pullback and is breaking out. And what do I like about Flowers Food? Well, it's breaking out above the 17. It has a new EMS indicator and has a breakout and momentum coming out of a squeeze. Now I could do a similar search on the short side. So it's weekend shorts, and let's go here. Let's leave price in 5. Squeeze is good, dots are good, but I want a bearish weekly bongo, and let's apply. And let's look and see if anything's got a EMS signal. And let's look down the list and let's see. I have not looked at this one, so it's a bad thing to do, is not knowing what the answer is, but let's look at St. Joe. The reason I picked St. Joe is it's got a bearish weekly signal. I know it's a stock that's been under pressure because the weekly and daily bongo are negative. It's in a squeeze, and what do I see? I see something that looks interesting if I was going short. I have a stock that's breaking down below the 200-day moving average with a fresh bearish EMS. It's got volume, breakdown or breakout to the downside, and momentum to the downside in a squeeze, and we can start to see that its relative strength has turned down. So I can use these signals to find stocks that are setting up for longs or shorts. Applied Materials, this is a great name. As you can see here on the daily, it's broken down below the 200-day moving average, and it's got a fresh EMS signal. It's got a number of red dots in a squeeze. Relative strength is broken down, and you could see here on the weekly, you had 3 or 4 attempts to get above the 50 weekly moving average. They failed. This is another one. So I've gone through, I've got a bullish and bearish watch list, and all this means, these are some stocks that I'm going to be watching that fit those criteria. I'll show you to them very quickly. You can always stop this to look at it. First thing you'll notice is that the buy watch list is, there's a lot of stocks here, but there's not a lot of technology here. We looked at several of them: Campbell Soup, Flowers Food, etc. Scale that down. And then before I go, I want to talk a little bit about WSR. Stocks that I'm looking at as potential shorts. Keep in mind, this is very much dependent upon what the market does. These are all stocks that either started to roll over. You can see they're all down year to date. But stocks that I thought might have potential to go further. Keep in mind that in these market rallies that I talked about, these bear market or correction rallies, the stocks that go up the most are often the stocks that have already started to fall, and they fail and go back further. These were some that came to my list. So again, none of these are recommendations to buy or sell. They're just some of the things that I'm going to be looking at. And then I mentioned I wanted to talk about that one stock, and I'm going to show you why in just one second. Last week at the end, I pulled up a stock, and that stock was called WSR. And it's probably too late to buy it, but it really exhibits what I'm looking for. And there were several things about this one that I really like. So first, let me make it, first of all, a little bit. There you go. So 1, 2, 3, 4, 5. I talked about it right here on last weekend. And I liked it because, as you could see, I've got those 3 green dots. 1, 2, 3 in a squeeze. And you could see on Friday, the previous week, how relative strength had broken above its moving average. So I called this out last week. Now what I like about it is, no, not just because it went up. It went up, that was great, because it went up and you had a chance to play it. If something has a big gap up and gaps up 20%, you can't, well, you can, but I don't usually chase. But what was really cool about this stock is that it gave you a great opportunity to enter. So when I talk about having a buy watch list and a shorting watch list, what I do is I want to find the stocks that start moving that I'm interested in. And so you could see that this one gapped up just a little bit, and you had plenty of opportunity to get into this stock and ride this up for the rest of the week. So how am I going to find those? So one of my favorite tools, and I'm going to end with this tool in wealth charts, and that's called Wealth Finder. And in Wealth Finder, I can create various lists, and then I could be sitting at my desk at work. Don't tell my boss. Actually, I'm one of the bosses, so it's okay. And I can wait and see what things pop up here. And I'm probably going to get interested when they get to be at about 15 minutes, because when they hit 15 minutes, I'm paying attention. And then this is how I might find stocks during the day, during the week. No, I can't watch 150 stocks at one time. Why do I want to? All I got to do is say I'll take the long list that I might have just put together. We'll call that here weekly buy. Come down here, I take the short list. And then over here I have a larger list that I follow. And I wait for the stocks that I'm following to start to populate the Wealth Finder. Last stock I want to talk about is one that came up when I was looking at a lot of charts. And I just want to show you it before we say goodbye. And I'm not sure it's going to be my WSR of the week, but Dollar Tree looked interesting to me. So I got to keep remembering to use the keyboard on the right computer. And here's Dollar Tree. So as I start to look at it, it's already ran a lot. The reason why I like squeezes is because I'd rather buy things that are lower in their pattern. This is setting up here at sort of a high base, gone sideways since Thanksgiving. So there's no squeeze right now. But what I got here is a very bullish looking day, a breakout on volume with momentum, relative strength turning up, and I'm going to be watching Dollar Tree as well. On that note, have a wonderful week, and I'm looking to start doing these on a more frequent basis and more to follow on that. Bye, everybody.